Hello and welcome to episode 46 of the Special Situations Report, a podcast by Inside Arbitrage covering the most intriguing event-driven activity over the past week. My name is Asif Surya.
And my name is Tamanna Surya.
And what we will cover on the podcast today is just a small part of what happened in the special situations world last week. For daily updates and alerts on special situations, as well as access to tools that help you identify opportunities, such as our merger arbitrage tool, check out insidearbitrage.com. Please also take a moment to like and subscribe to this podcast on whatever platform you may be listening on.
We are continuing with our new format by focusing on 4 key stories, including the massive $23 billion acquisition of Exact Sciences by Abbott Laboratories, the spinoff of Topgolf from Topgolf Callaway being converted into an asset sale to a PE firm, a buyback at a clinical stage biotech that is pivoting to a royalty-based business model, and a large secondary offering and insider purchases at Biohaven. Before we begin, we want to state that nothing on this podcast is meant as investment advice, and please refer to our full disclaimer at the end of the podcast for more details.
So let's kick things off with deals in the works. The broadcasting company Sinclair, which owns and operates 185 TV stations across 85 markets, has built a roughly 8% stake in a smaller competitor, EW Scripps, which owns about 60 local TV stations. Sinclair has an enterprise value of $4.8 billion. They have a ton of debt on their balance sheet, compared to EW Scripps' $410 million. So in some ways, it would be a small tuck-in type of acquisition, and it's unlikely to run into regulatory issues that Sinclair's largest competitors, Tegna and Nexstar, are running into right now. After an acquisition of Tegna by Standard General fell through in 2023, Nexstar decided to try its luck in August of this year with a $6.2 billion deal that will combine the top broadcaster with the third largest broadcaster by revenue. The consolidation was expected with the appointment of new FCC chairman Brendan Carr, but last month, the Department of Justice threw a monkey wrench into their plans with a request for additional information, which is also known as a second request and often scares merger arbitrage focused investors because that means the transaction or the deal can take much longer to complete. As a result, the spread on the deal is now a little over 10%. Even though the FCC might be more open to an acquisition of EW Scripps or an even smaller Entravision by Sinclair, I can see the DOJ taking a closer look at those deals if the Nexstar Tegna deal is allowed to close. We've covered Sinclair in the past, both on Inside Arbitrage and on this podcast, after Sinclair was considering spinning off its non-broadcasting assets, and Executive Chairman David Smith started buying shares multiple times on the open market in March and April. EW Scripps saw its stock jump up 40% in response to this news that Sinclair is taking an 8% stake in the company. I remember when you and I were looking at Sinclair a few months ago, maybe it was about a year ago, you were quite amused to see some of the additional non-broadcasting properties the company owned. And if I'm not mistaken, one of them had to do with golf.
We'll actually talk about golf later on in this podcast. But for now, we'll continue with another update about another deals in the works that's been developing. So Lynx One Capital, which had submitted a bid to the board of the biotech Euphoria for $5.20 per share in cash, actually withdrew its offer this week. Mind you, this is an incredibly tiny company, less than $10 million in market cap, and the shares were trading at around $4 per share when the offer was first announced. Lynx One had said that the offer price was based on then publicly available information regarding Euphoria's capital structure and balance sheet. The board's recent actions have dramatically altered the capital structure and balance sheet. Now, my read on this is that given that Euphoria is trading below the value of the cash on its balance sheet, it's a zombie biotech that Lynx One was looking to acquire in order to get access to that extra cash. The balance sheet and capital structure changes could also be tied to the poison pill that Euphoria adopted in order to prevent the acquisition. Now, this is a super tiny deal that we normally wouldn't talk about, but it's interesting to see a zombie biotech pop up once again, and that's why we figured it was worth at least a mention. We haven't seen a lot of zombie biotech acquisitions since the start or mid of this year, where they were really coming in hot.
Indeed, and that's why I think you should focus on not the very smallest end of the zombie biotech spectrum, if you will. Moving on to another potential deal, there was an update related to the potential acquisition of Warner Brothers Discovery by Paramount Skydance, which was initially reported by CNBC in September of this year. A deal price of $22 to $24 per share was reported, and then about a month later, there was news that Warner Brothers had rejected a $20 offer from Paramount Skydance as being too low. When we talked about a potential deal for the company in episode 41 of this podcast, the stock was trading at a little over $18 per share. It now trades at a little over $23 per share, so it's gone up quite a bit since then. And the enthusiasm for the stock is related to a potential bidding war, considering there are three players now involved. The Wall Street Journal reported that along with Paramount Skydance, Comcast and Netflix have also submitted bids for the company, although it is only Paramount Skydance that has shown interest in the full company. As a Netflix shareholder, I would much rather them continue doing what they do with original programming instead of attempt to buy the library from Warner Brothers Discovery. But let's see how all of this plays out in the next few weeks.
Exactly. It's a pretty big deal that might come to fruition, and we've been tracking it very consistently on the podcast as each new development comes to be. So interesting to see how it'll all play out at the end of the day.
Indeed.
Moving on to another deals in the works situation, something we discussed last week was the potential acquisition of the accounting and investment software platform, Clearwater Analytics. Warburg Pincus and Permira were the two firms named to be interested in Clearwater, which makes sense considering that the two firms were the ones to take the company public in 2021. We talked more about the rationale for the deal in our last episode, but this week it was announced that the technology-focused private equity firm Thoma Bravo also made an offer to acquire the business, possibly adding to a pre-deal announcement bidding war. I'm curious to see if a deal is ever actually announced, what the price might be at, how much of a premium is going to be paid, with now three different firms interested in the business.
Fascinating story, both on the Warner Brothers side and this one. Moving on to our first big story of this podcast, it's actually a new M&A transaction and one of the biggest ones we've seen the last several weeks. In the month of October, there were 26 new deals that were announced with a total deal value of $112 billion. This compared with about 25 deals with a total value of $58 billion in September. It looks like November is shaping up to be even hotter than October, with $44 billion worth of deals announced just last week. The largest of these deals was the massive $23 billion acquisition of Exact Sciences by Abbott Laboratories for $105 per share in cash. Exact Sciences saw its stock close at $100.90 with a spread of 4% on the deal, or almost 7% annualized if the deal can close by mid-2026. So what exactly does Exact Sciences do? They create tests that help in the early detection of various types of cancers, including colorectal, prostate, and breast cancer. Exact Sciences has a new test now called Cancer Guard that can detect signals from 50 types and subtypes of cancer, including 80% of annual US cancer diagnoses, including pancreatic, ovarian, liver, and lung cancer. The company announced this new test in September 2025 and has partnered with Quest Diagnostics to collect blood at 7,000 of its locations, as well as enabling blood collection at provider clinics and services for in-home collection.
So how is this Cancer Guard test priced, and is this why Abbott was interested in acquiring the business, or was there anything else?
Yeah, I was interested to see how this would play out and what the pricing might look like. The test is priced at $689 and is recommended annually for adults in the range of 50 to 84 with no known cancer diagnosis over the last 3 years. I can see this quickly becoming a standard of care for older adults if the test has 68% sensitivity across 6 of the deadliest cancers and 64% overall sensitivity over a broader range of cancers, including breast and prostate cancers, as claimed by the company. You can start to see why Abbott Labs was interested in this deal, especially since Abbott's diagnostics division has seen its revenue shrink after the big surge from COVID-19 related testing subsided. Exact Sciences is expected to generate more than $3 billion in revenue this year. And once the deal is complete, Abbott's diagnostic sales are expected to exceed $12 billion annually. To put this in perspective, Abbott had over $11 billion in revenue last quarter, and last year revenue was nearly $42 billion. Abbott had about $7.7 billion of cash on its balance sheet last quarter and nearly $13 billion in debt. So basically, the balance sheet has net debt. The company will have to raise a large amount of debt to fund this massive deal, considering it's opted not to use its stock for the acquisition and is paying all cash. As is often the case these days, there was a rumor the day before the deal was announced, and the stock had jumped up from nearly $70 per share to $86. And then the deal finally came through the following day at $105 per share.
We'll continue on to the spin-off section of this podcast. One of the ongoing special situations bonanzas, as I like to call them, that we've been keeping our eye on for quite some time was Topgolf Callaway, a golf equipment, apparel, and accessories manufacturer and retailer that has seen its fair share of insider purchases, C-suite transitions, a merger, and now a spin-off. Callaway Golf Brands was first founded back in 1983 and soon grew to be one of golf's largest players, especially when it came to equipment manufacturing. In 2020, the company announced its acquisition of Topgolf, a chain of entertainment-oriented interactive driving ranges, an acquisition that completed in 2021.
Why did Callaway want to acquire Topgolf?
So the company was hoping on capitalizing on the renewed interest in golf that had sparked during the COVID-19 pandemic, and then Topgolf's widened demographic reach. At the time, Topgolf was growing like crazy by targeting non-golfers and casual participants, especially encouraging group outings and corporate events. Customers were also only committing to a 1 to 2 hour experience, as opposed to the typical 4 to 5 hours for a traditional round of golf. Weather concerns were also limited through the climate-controlled hybrid indoor and outdoor venues that Topgolf operates. With only 1/3 of a Topgolf venue's sales coming from gameplay, and with the rest coming from food and beverage, corporate events, and technology licensing, each of Topgolf's largest venues at the time was generating $20 million to $30 million in sales. By August 2022, Callaway announced that it would rebrand as Topgolf Callaway Brands, as a result of investors suggesting that an emphasis be placed on the Topgolf acquisition. The company's CEO suggested that the subsidiary could account for over half the combined business's earnings by 2025. On September 4th, 2024, though, Topgolf Callaway announced that it would undo the merger and split into two separate, publicly traded companies by late 2025. The two companies would be Callaway, focused on golf equipment and active lifestyle products, with $2.5 billion in revenue, including Toptracer, and then Topgolf, a high-growth venue-based golf entertainment business with $1.8 billion in revenue.
So why were they now considering a spin-off?
So the company more or less stated that the merger did not prove to be economically successful due to market conditions, and its share price had declined from around $29 per share to $10 per share since the completion of the merger. Callaway is a high-margin golf equipment manufacturer, while Topgolf is a capital-intensive entertainment venue operator with lower margins and then different capital needs. That too, by the end of the pandemic, the novelty of Topgolf had waned, as same-store venue sales began to decline and the company struggled to open new locations, which is another capital-intensive process. In some sense, this entertainment situation reminds me a lot of what played out with Pinstripes, a bowling and restaurants company where the company just couldn't sustain its initial popularity and hype. Now, as part of the spin-off, Callaway was going to retain at least a 19.9% stake in Topgolf and assume all of Topgolf's Callaway's debt, enabling the spin-off to operate debt-free, which is very atypical because companies tend to load up their spin-offs with a ton of debt. The spin-off was expected to complete in the second half of 2025, as I mentioned earlier, but at the end of July, it was announced that Topgolf's CEO, Artie Starrs, had resigned to join another company, and the spin-off would be delayed until 2026. Now, this week, it was announced that Topgolf Callaway would instead sell a 60% stake in its Topgolf and Topracer business to Leonard Green and Partners, an LA-based PE firm, and a deal valuing the unit at $1.1 billion. The transaction will generate about $770 million for Topgolf Callaway and is expected to close in the first quarter of 2026. After closing, the company will rebrand as Callaway Golf Company, trading under the new ticker symbol CALY, and focus on its core golf equipment brands such as Callaway, Odyssey, and more, which generated around $2 billion in revenue over the past year. The Topgolf loss was not the only loss that the company suffered. In April, Topgolf Callaway announced that it was selling the Jack Wolfskin brand to Anta, which is a Chinese multinational sportswear company, for a reported $290 million. Jack Wolfskin is a German brand that makes outdoor apparel and camping accessories, which Callaway had purchased in early 2019 for $476 million.
So that's a wonderful return on capital, I guess, on that brand that they bought from a German company and now they're selling to a Chinese company. Didn't we also see some insider purchases at the company back in June?
Yeah, we actually talked about Topgolf Callaway on this podcast in June after a series of insider purchases by various executives and directors. At the time, Topgolf Callaway stock had actually dropped to the $6 to $7 range. So while the roughly $10 per share that the stock trades at now is a far cry from the highs of over $37 per share it once traded at, the purchases were still quite well timed.
Indeed, they were. Looks like those executives made money on that purchase. Switching gears to stock buybacks, the buyback we wanted to talk about this week is of a biotech company that is converting into a pharma royalty company and saw its stock go up more than 190%. Zymeworks is a biotech company that is developing an antibody to treat biliary tract cancer, a type of cancer that affects bile ducts and the gallbladder. Its product called Ziihera was licensed to Bygene and Jazz Pharmaceuticals, and the company could receive near-term milestone payments related to future regulatory approvals of up to $440 million. So let's break these milestones down. $250 million would be paid if the product is approved in the US, another $100 million if the product is approved in the EU, $75 million from Japan, and then the rest from China. Beyond Ziihera, the company also has a product under development for the treatment of prostate cancer that could generate $434 million in additional milestone payments from Johnson & Johnson. They also have the right to receive mid-single digit royalty on sales of this prostate cancer treatment. We took a look at the company after Zymeworks announced a $125 million buyback, representing 7% of company's market cap at announcement.
Yeah, that threw me off a bit when I first saw that piece of buyback news come through. And I remember talking to you immediately after. Because the question was, why would a clinical stage biotech be spending capital on a buyback instead of developing drugs? Because as we know, typically, clinical stage biotechs are always issuing secondary offerings, issuing more shares in order to get capital to continue that cash runway and develop their drugs.
Yeah, seeing a buyback announcement, as you said, from a clinical stage biotech company with hardly any revenue felt odd, despite the fact that the company had nearly $250 million of net cash on the balance sheet. We were also intrigued by the fact that a quant model gave the company a score of 86 out of 100. It was also interesting to see that multiple insiders were purchasing stock at the company earlier this year, with 10% owner Ecor One Capital buying shares in the $11 to $14 range. The stock currently trades a little over $24 per share, so those insider purchases were also very well timed. Ecor One Capital's Oleg Nodelman and Scott Flatson also serve on Zymeworks' board. And to make things even more interesting, Scott Flatson is taking on the role of acting chief investment officer at the company.
So is Zymeworks completely converting to a royalty company, or are there any intermediary steps?
As we saw with Ligand, the process takes a while, and it looks like while they are going to take steps to build their royalty portfolio through existing licensed products and acquisitions they plan to make, it also looks like they plan to continue funding some internal R&D. If this company turns into another Ligand, the key question would be if they have the right talent to identify and bet on the right candidates. A very interesting situation where the buyback didn't make a lot of sense initially, but I can see why they want to have that buyback authorization in place as they now focus, instead of just pure R&D, on a capital allocation and acquisition strategy going forward.
Yeah, it's always interesting to see a business pivot, especially as one of these clinical stage biotech companies. There's so many out there. Honestly, there's not that many royalty companies, so I'm interested to see what the future of Zymeworks holds.
Yeah, there are three publicly traded royalty companies, as we have seen. Ligand is one of the ones we follow the closest. And I've had some conversations with their CEO and their CFO. And then there is Royalty Pharma, which is one of the biggest ones. And I was looking up at the price chart of Royalty Pharma and hasn't done quite as well over the last 5 years. Ligand has done very well since its spin-off of OmniAb. And then the smaller one you and I see a lot is Zoma Royalty, which seems to not hesitate in picking up these zombie biotechs for the extra cash that they can hoover up from them.
Absolutely. We'll continue with this biotech theme as we switch over to the insiders section of this podcast. And for readers or listeners who have been following Inside Arbitrage for quite some time, the biotech Biohaven must be a familiar name. The company is another one of these special situations bonanzas that first showed up on our radar in May 2022 after Pfizer announced its acquisition of the original Biohaven pharmaceutical, where in addition to paying $148.50 per share in cash, certain assets of Biohaven would be spun off into a separate publicly traded company, which is the Biohaven that trades under the ticker symbol BHVN today. Many parent companies tend to load their spin-offs with large amounts of debt, but in this case, the new Biohaven was seeded with $275 million in cash and was also set to receive tiered royalty payments related to the sales of certain products and candidates that Pfizer was acquiring. A few days before the deal closed, we saw a director of Biohaven purchase shares at a price of $148.04, which is surprising because the deal price, as I mentioned earlier, was $148.50, and that there was no way that the director was purchasing shares for that tiny of a spread. It looks like he was buying into the spinoff instead, which, when we revisited the company in April 2024 after a series of insider purchases then, proved to be the right move. When we revisited Biohaven, the company was up 500% post-spin and was up nearly 198% over the last year, despite a pullback from its highs of more than $60 per share.
Yeah, I remember participating in that merger arbitrage situation, both for the spread, which was higher before that director purchased, as well as for the spin-off. I was kicking myself for not holding on to that spin-off after the company separated into a new Biohaven. But how has Biohaven been performing now? Didn't we see a new secondary offering with multiple insiders participating last week?
Yeah, and we actually saw an insider purchase shares at a slightly higher price outside of the secondary offering as well, which we found interesting. But the reason you're probably not kicking yourself as much is because tides have turned at Biohaven. The stock is now down 80% in the last year, and is only up about 32% post-spin. Well, what caused the stock to be beaten down that badly? It's a combination of multiple factors, including the failure of various drugs in its pipeline, significant competition from other companies developing similar candidates, and the FDA's rejection of a key new drug application. Now, at the start of this month, the FDA rejected Biohaven's request for the approval of Viglixia, or troriluzole, a drug that's meant to treat SCA, which is a group of rare diseases caused by the degeneration of the cerebellum and spinal cord, creating progressive problems with movement, coordination, balance, and eventually leading to death. Biohaven has been pursuing approval of this drug since 2023, even after the phase 3 trial missed its primary endpoint. The FDA refused to review that submission, so Biohaven pivoted to using 3-year real-world findings in order to support a resubmission. Biohaven posted positive 3-year real-world findings in September 2024, which demonstrated that disease progression appeared to slow between 50% to 70%. However, at the start of this month, the FDA issued a complete response letter rejecting the new drug application, citing concerns about the potential bias inherent to the real-world evidence design and unmeasured confounding factors in external control studies due to the lack of a placebo group. In some sense, this could have been predicted, as Biohaven actually withdrew its European marketing authorization application in late March 2025 after the EMA indicated that it would likely reject the filing. Another key candidate that Biohaven was developing to treat spinal muscular atrophy, failed to meet its primary endpoint in its phase 3 trial in November 2024. And while the company announced that they would engage in talks with the FDA in the first half of 2025 to consider a pivot to treating obesity with this drug instead, it seems as if no significant progress has been made on that front either. We last talked about SMA on this podcast a few episodes ago, when we talked about another biotech that we saw insider purchases at, Scholar Rock Holdings, which has actually seen clinical success for its drug to treat SMA. So Biohaven is facing significant competition on that front, especially considering their drug has already failed trials where Scholar Rock Holdings' drug has succeeded.
So, with its two main candidates gone, what's left for Biohaven?
Yeah, the most concerning thing about Biohaven is how quickly the company is burning cash. They last reported R&D spend of around $141 million and a net loss of around $173 million in Q3 2025. This is highly unsustainable, especially given that the company's two drugs that were closest to achieving commercialization are no longer in play. The secondary offering that the company announced this week raised about $200 million in gross proceeds and gives the company a little bit more runway. But how long that will last without any commercial or even pipeline success is the major question. Biohaven announced that they were planning to cut R&D spend by over 60% following the failure of troriluzole, as they prioritize three key platforms: a protein degrader meant to treat an autoimmune condition known as Graves' disease, another protein degrader to treat a prominent kidney disease known as IgA nephropathy, and then BHV 7000, which is a Kv7 activator meant to treat epilepsy and major depressive disorder. Both degraders are still in phase 1 trials, meaning the fate of Biohaven rests largely on BHV 7000, with the epilepsy studies in phase 3 and the MDD study in phase 2 expected to come out with top-line results in the first half of 2026 and the end of 2025, respectively. Until then, it becomes a lot of a waiting game because there's not much else to work with. The other candidates in Biohaven's fairly robust pipeline are in very early stage, and the company has actually announced that they will deprioritize those candidates in order to focus on these three main ventures.
This is a highly experienced management team that led the company's success with their migraine drugs, which is why Pfizer acquired the company. And I was hoping to see that they would probably repeat that with this new slate of candidates that they were working on. But let's see how it all plays out. Switching gears to activists, Bloomberg reported that activist investor Elliott Investment Management has taken a large stake in Barrick Mining, or Barrick Gold as it used to be called before. The investment follows the sudden departure of the Canadian mining company's chief executive officer, Mark Bristow, in September, and comes as the company plans to refocus on its North American assets. As we've seen with a lot of gold and silver companies, Barrick has also done well over the last year, and it's taken a long time for the company to get there.
It'll be interesting to see how activist involvement plays into mining's future as well. We'll wrap this podcast episode up with a quick look at C-suite transitions. IonQ, our favorite quantum computing company that is up 35% in the last year and up over 286% since it went public at the start of 2021, on pure hype alone to be entirely honest, just saw its chief revenue officer resign this week, effective immediately. Quite frankly, this move makes quite some sense. IonQ and the quantum computing industry as a whole is still years from making quantum computing feasible, yet alone being able to commercialize it in order to generate revenue. So to even have a chief revenue officer made no sense. Granted, along with the massive losses that the company was generating, a bit of revenue has been generated through various contracts with different labs and some hardware sales. But again, most of the quantum breakthroughs have been driven by much larger players in the space, such as Google and Amazon, rather than independent quantum computing companies like IonQ. This C-suite transition adds to the list of executives that keep leaving IonQ, starting with losing its chief scientific officer and co-founder back in October 2023, which already raised questions about the viability of the quantum computing technology that IonQ was developing. The company also lost their other co-founder and chief technology officer in March 2024, thus leaving the company without the two pioneers of their own technology. At the start of this year, Nicola De Masi was appointed the CEO of the company, replacing the former CEO, Peter Chapman, who continues in his role as executive chair. Nicola De Masi has been on IonQ's board of directors since 2021 and was CEO of the SPAC that took IonQ public in 2021. It's rare to see the SPAC leadership come back to take over the company they merged with, especially considering how technical and specialized of a business IonQ is. The chief revenue officer is certainly less technical of a role, and in this case might actually be a role that needed to be vacated, freeing up even the tiniest bit of capital to be spent on developing that quantum computing technology further.
Yeah, I remember Nicola Di Masi from back when he took on the CEO role at Glue Mobile, a company that was going through a transformation when smartphones first showed up. And he helped the company become profitable and eventually through its acquisition by EA. So it's interesting to see him take the leadership at IonQ. And maybe he can pull this off again. But to your point, there's a lot of hype and froth in this segment. And it'll be interesting to see who the real winners end up becoming.
Exactly. And with that, we will wrap up episode 46 of the Special Situations Report. What we cover today is just a brief overview of the special situations landscape. So if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and visit our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as tools to help you identify opportunities such as the merger arbitrage tool. Check out insidearbitrage.com.
And if you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on. And especially share it with your friends who are interested in special situations. Thank you.
We also wanted to provide a brief reminder that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decisions. Thank you.